Imagine rolling over your life savings into a new retirement account. You deposit $300,000, and on day one, the balance immediately jumps to $330,000. For a retiree looking for conservative growth and principal protection, that $30,000 head start is an incredibly compelling way to begin a new financial chapter. But insurance companies are businesses, not charities. That massive influx of capital has to come from somewhere within the math of the contract. The 10% bonus is mathematically real, but it is a calculated corporate pricing decision made by the carrier to attract long-term money. To avoid a costly misunderstanding, you have to decode the actual mechanics of these contracts. That is why buyers rely on the 4 decades of market expertise at Diversified insurance brokers to reveal the true cost of the bonus. The single most important rule to understand is this: where exactly the bonus is credited matters far more than the advertised percentage. An account value bonus becomes actual liquid cash, improving surrender value and the death benefit. But an income-based bonus is a phantom calculation bucket. Used exclusively for future lifetime payouts, it is purely mathematical and cannot be cashed out. Even when the bonus hits your account on day one, you do not legally own the entire amount immediately. These contracts use vesting schedules to slowly transfer ownership of the bonus to you over a set period of years. If you try to surrender the contract early or take excess withdrawals, the carrier has the contractual right to claw back any unvested portion of that bonus. Because of these strict bucket distinctions and rigid recapture rules, the bonus rewards long-term commitment while penalizing short-term liquidity. So how does the insurance carrier balance their financial books after handing out a massive upfront credit? They do it by pulling invisible pricing levers. Carriers offset the upfront bonus by offering more conservative market growth potential over the entire life of the contract. This chart shows a cap restricting your upside, a strict limit on interest earned, regardless of market performance. Another lever is the participation rate. Instead of matching the market at 100%, a 50% participation means your account grows at half the speed. Carriers can also apply a spread fee, which is an administrative percentage deducted straight off the top of the index gain before any interest is credited. This timeline compares a 10% bonus annuity against a non-bonus annuity over 10 years. The bonus clearly starts higher, but watch over time. The non-bonus annuity grows faster each year, eventually crossing and exceeding the bonus line by year 10. Because the non-bonus product typically has higher caps and participation rates, it mathematically outpaces the upfront bonus in pure cash accumulation. A 10% bonus is a direct trade-off equation. You are exchanging long-term growth velocity for an immediate, locked-in capital advantage on day one. This trade-off works perfectly for a specific buyer, a pre-retiree who plans to roll over an account and wait several years before taking income. That deferral period allows the high starting base to compound significantly. It is the wrong choice for an investor seeking maximum short-term cash accumulation, or anyone who anticipates needing early liquidity. Purchasing a product based solely on the highest advertised bonus percentage without calculating the net result over your exact time horizon is a fast way to underperform your financial goals. Finding the exact balance between the upfront bonus and those invisible pricing levers requires an expert broker who can run side-by-side illustration comparisons across the entire market. Leverage the 40 years of experience and the massive selection of annuity products at Diversified insurance brokers to match the exact mechanics of the market to your specific retirement goals.